Yeah, that's how the market is. Whoever loses the money he puts into the stop loss, whoever loses his stop loss is the person that is being liquidated, whether you are new or not new. Sometimes even experienced traders take stop losses. You understand? But the whole concept I'm trying to explain is that when you come into the industry new, unless you go directly to a system or a strategy that knows about liquidity, but most strategy don't teach liquidity.
Okay. All right.
All right. So it's just liquidating is just like somebody has to bring for somebody have to make. So who is bringing the money is the one providing the liquidity.
Okay, that's understandable.
All right, Israel, are you good? All right, so let's talk about the types, or you can read this by yourself too. So here it said liquidity is simply the stop loss of a retail trader who finds himself on the wrong side of the market. Whoever loses, if you lose, you are the one you are being liquidated. You know, this term, I mean even Nigerian term say, oh yeah, they your head, like oh yeah, no they my hand. If somebody talk to say, oh yeah, no they my hand, that be like, you know, get money, right? It's Nigerian term. Oh yeah, no they hand. So you see, oh yeah, is liquid. So those kind of terms, that's what is being related here. That's why I call it liquidity. It's kind of like, you know, when your hand is grazing, then it has money on it. But if you don't have money, then your hand is not grazing. So it says in the community, like the one we look at, if you look at some of the analysis I sent to you guys, there are some places that mark as bull grab, some places that mark as bear grab. What he's trying to say is that the bull grab and the bear grab is when the stop losses, the bull grab is a liquidity is originated by stop losses of sell orders. The bull grab liquidity is originated by stop loss of the sell orders. Let me check some and see. Let's look at one practically so you guys can get. Look at this place here. You see, normally when you come into the market, those that trade the double top and double bottom. I don't know if you guys can see the lines here.
Yes.
So if you trade a double top and double bottom, you know very well like this is an impulse or this is the first leg of the M. Then this is the second leg of this is the midpoint. Then you went back up again to create the perfect double top with this previous top. So the wholesalers are going to be here right there. They will take their sales, either the close of this shooting star or something. Then definitely your target is at the first leg, the beginning of the first leg. That's where they target. Those who trade double tops and double bottom, that's where they target. So because their target is here, now the market will make you one thing. There's something as you say. They say that when you think you are smart in the market, it will make you feel more smarter. You understand? When you feel like a god, the market will make you feel like you're omnipotent. You understand? So when you do your sales here, it will be in your direction for a while so that you become confident in your trade. Then after that, you just go and then take you out. Now, when you take your sell, where's my sell position? When you take your sell right, let's say there, your stop loss can't be as big as this. That is impossible unless you don't know what's called risk management. You can't put your stop loss as big as that. Your stop loss will be a little bit like, let's say, okay, this is counting over 100 pips. So let's take 100 pips as a stop loss. Let's leave it like 112. So your stop loss can be there, or let's say a little bit further. But your stop loss can be big enough to cater for all of this. It's very, very impossible. You can't do that unless maybe you are trading without conscience or you don't have money conscience. You can't put your stop loss like this. So when your stop loss is there, now you see that when the market came back here, what happened is that it used a bullish candle to grab you, to take the stop loss before falling in your direction. That is why we call it bull grab, because it is a bullish candle that goes to grab it. That's why it's called a bull grab. So reverse is the case for the sellers, for the buyers too. When you buy, you put your stop loss below. So your stop loss is being grabbed with a bearish candle. I'm trying to figure out a buying scenario. This guy has been buying, he's selling here. This guy has been buying for a very long time. 75 spot. All right, look at this page. This is a buying scenario, right? This is a double bottom. This is a double bottom. This is a buying scenario. So you take your bias here. You take your bias here. Your bias is there. So you take your stop losses a little bit below it. Now you see this place, your stop loss is tagged even before your profit is tagged. The candle that comes to take your stop loss is a bearish candle. Even if it's having a bullish week here, it's a bearish candle. there's a bearish candle that took the stop loss. Israel, your noise, someone is talking there that is kind of disturbing. So there's a bearish candle that comes to grab the stop loss. That's why it's called bear grab. So the type of candle that grabs the stops is the one that's how we relate the name. If it's a bullish candle that grabs the stop loss, it's a bull grab. If it's a bearish candle that grabs the stop loss, it's a bear grab. And then a bullish candle can only grab the stop for the selling position, because when you sell, you want it to come down, right? So when a bullish candle goes to take your stop loss, that is when we call it a bull grab. Then when you buy, you want it to go up. When a bearish candle comes against you to take your stop loss, that is when it's called a bear grab.
Okay.
So, is there any complications?
I believe you're kind of too fast there, though.
Sorry.
Kind of too fast there.
Okay, if we read this, it's a lot of traders sell from double top, having their stop losses above. That is what I just illustrated. When you see a double top like this, a lot of traders will sell and then they have their stop losses above it, because when you sell, you want the market to go down, right?
Yeah.
Now it is being called a bull grab because the kind of candle that goes to take your stop loss is a bullish candle. It goes up. When the candle is going up, it's a bullish candle. So since the candle that took your stop loss is a bullish candle, it means the bulls grabbed you. When they say bulls, you know that it's buys or the uptrend people. When they say bulls, it's buys. So the buys grabbed your own stop loss before going your direction. That's why it's called a bull grab. And then when you talk about the sells, the bear grab, you know, when you buy the market, you want it to go up. So you have to put your stop losses below your entry so that it can go up.
Yeah.
So the candles that comes to grab your own stop losses on the below is always a bearish candle. The sellers come to take you. That is where it's called a bear grab.
Okay.
So if you have any scenario that you have to sell, you know that the only kind of liquidity that you can fall into is a bull grab, because you are selling and your stop loss is above. Then if you have a market for you to buy, the only kind of liquidity you can fall into is a bear grab, because it can only go against you with bearish candles.
Okay.
Hope it's clear.
Yeah, that's clear. That's better now.
So if you also go through the video, you understand more. I recorded the video. I posted 4 days ago, so it's there.
Okay.
So the bear grab is just the difference, the opposite of it. The market is only two ways, either buy or sell.
Yeah, buy or sell. Yeah.
So this is for the trendline liquidities. Inducement. So is the bull grab and the bear grab clear? Israel, are you there?
Yeah, I'm here.
Hope it's clear. Hope I'm not too fast, or maybe
Yeah,
you can ask questions if you don't understand.
it's very clear.
So this inducement, we made the video and then I'm still editing the videos before I give it to you guys. Inducement is talking about when the market is trying to show you that it's time for you to buy, or this particular ends, you have to enter the market. But that one is a trap. It's not the real kind of entries. If you filter very well, that isn't supposed to be the real entry. But when you don't understand these things very well, you are definitely going to fall for it. So you are being induced. This kind of like, let me look at the trade I sent to you guys, the last trade. I want to show you guys something from it. I think there's an inducement there as well. Yeah, this particular trade. You see this top level. This top level can be called inducement because a lot of people will take the buy from there, but it's inducement because that is not really where you're supposed to take the buys. You have to wait for it to dip a little, then you go to the 1 minute for you to get a proper entry. When we do practically how to analyze the charts on the Zoom like this, you guys will understand how we get to draft all of this out, how to spot the entries by yourself, how to know. Now look at the bear grab as well. I can't zoom in the picture anymore. Look at the bear grab as well. You see, we're looking for buys, right? So the only thing that can take us out is a bear, like the bearish candle that can come against us to grab the stop loss that we put up below here. So this is a bear graph already happened. This place and this place. A lot of people already bought because it's a double top already. It's a double bottom already. So a lot of people already bought. So if you look very well, you see the some candles came below. So he grabbed them, and then that's when we know that a bear grab happened there already. So after the liquidity, that means there's a lot of money to be paid out. So if you join the market right now, you get the profit because people have been stopped out. People's money have been grabbed. So you just have to get in and make it. So after liquidity, then the market goes well. That's how it is. There must be a liquidity sweep before profit can be made. If there's no liquidity sweep before you want to make your own profit, you will end up being the liquidity. So this one is just like inducement. The English inducement is just like illusion. That illusion, that's how it is. Some of them is not really supposed to be the zone you're supposed to target your entries, but the market will make you feel like those are the places you're supposed to put your focus on. I'm here to make a video to upload the video on this inducement. So I'm not going to talk about it for a long time. If you go through the liquidity video, you get to understand the liquidity very well. But the inducement, I'm still going to make a video on it because I want to talk about it when I talk about the entries. Because that is when I can tell you this particular entry, don't take it. Go for this type. So we'll talk about inducement when we're talking about the entries. So that's the conclusion for liquidity. Israel, do you have any question? You are the one that specifically talked about liquidity.
Yeah, it's clear now. I understand it well.
All right. So what else don't you understand? Apostle, you said market structure.
Yeah, market structure. Okay.
Is it all you have gone through? Are you good? Like, is that all you want to ask?
Yeah, I am now. So if I go through other ones, I'll ask more questions.
All right. So Apostle, market structure. The structure, you see is this the market structure? No, this is the multi-time from my life. Market structure, the English is clear, Masa. Why? Is that English not clear? Structure. The house you are living in, no get structure.
No get structure. I cardboard it is.
That's why you know they get network. Bro, market structure is only having a video, no
PDF, yeah.
no PDF for the market structure yet. Shit. Market structure. Okay, let's do on the charts. Then you see.
Okay.
When you talk about market structure, you're talking about the trend. You understand? What is the structure of this thing? Like, how is it looking like? You can see this clearly. This thing is looking like it's going up. The structure is ascending. It's an ascending structure it has.
Like a hill.
It's an ascending structure. Since it's creating, I'm sure already you understand when I said it's creating highs and higher highs and higher highs. You see, and higher highs. Then it's creating lows, higher lows. You see, higher lows. Yeah. So you know that it's in an uptrend. That is what the structure is trying to say, just like that.
When is it what?
Uptrend, like it's going up.
Okay, uptrend.
So it's going up, certainly. Okay. When it's creating higher highs and higher lows, the structure of the market is uptrend.
Okay.
And when it's creating lower highs and lower lows, the structure of the market is downtrend. Let's look for some of them. Because this guy have been down since, has been going up for a while, since 2 months ago. So this place, you see the market, you see the highs, each high is lower than the previous one. This high or this one, let's call this the first high. This high is lower than this high.
Okay.
This is a low. This low is higher than this low. So this low is lower than this low. This high is lower than this high. So it is in a downtrend because it's creating lower highs and lower lows. So the structure. So the structure of this market is a downtrending structure. Structure is just like telling you what is the particular thing happening right now, like overall what's going on. That is the structure of it.
Okay.
So here is another high that is lower than the previous high. Another high that is lower than the previous high. So since it's like that, then it is creating, then it is in a downtrend. Then let's see the third one. If I'm too fast, you have to slow me down, bro. Let's look for a third kind of market movement. The next one or the third one you saw it in the video. It's a consolidating kind of market. Like the highs and the lows are not really defined to be higher than each other or lower than each other. They're just like in a particular range, like this one. This ends like this.
Okay.
You see, it's not really going anywhere. Here, this one, this high here is lower than this one, right? So
Yeah.
approximately, or if it's supposed to be like a higher highs, then this high is supposed to be at the top somewhere here, but it's not there. Instead, it is here.
Yeah.
It is here,
So
even
it's
lower than
down.
this.
Yeah.
So it's kind of irregular. It's not really giving a trend. So it's called a consolidating market. This kind of market, I have to, when I put it in the box like this, you have to wait for it to come out of it, then you can get a picture clear, or you have to dive down to the smaller time frames before you can trade in between them, which we will do. You guys will get to see and have to understand how to deal with it. So when the highs and the lows are not really defined to be in a particular direction, either trending up or trending down, it's called consolidating market. It's consolidating or in a ranging market.
Okay.
But when it's creating higher highs and higher lows, it's in an uptrend. Then lower lows and lower highs is in a downtrend. Apostle, you born kiddie.
Not be me.
You know, be you get kiddie.
Me get kiddie. Me I dey alone, you know now.
Israel, you get kiddie for that.
I dey alone, like I dey alone.
Israel, you have a child?
Yeah.
Okay. Say hi to him.
So don't worry, I go preg my guest soon. Don't worry.
Like hi, bro. So is there any other thing, Master Jamie? Is there any other thing? We are